Good afternoon and welcome to this Yellowstone Advisory webinar with Halma PLC. I'm delighted to introduce Charles King, Head of Investor Relations, and Melanie Horton, Deputy Head of Investor Relations. I'd now like to hand over to Charles to start today's presentation.
We're really delighted to be here to present our half-year results to you. It's a strong set of results, as you'll hear, and Melanie and I will give you a bit of colour around some of the individual moving parts in those results. So let's move to the next slide, if we could please, Alex, and just the summary of those results. As you can see, it was a record set of results, record revenue and profit, and importantly, a couple of significant milestones reached during this first half. So for the first time in the first half of the year, we had revenue of over £1 billion, and we had adjusted EBIT, adjusted profit of over £200 million for the first time. So a couple of quite significant milestones reached. And it's really great to see that reported performance being underpinned by a strong foundation of organic growth. So double-digit increases organically for both revenue and for profit. And alongside that growth, we've continued to deliver strong margins, high returns, and as you'll see later in the presentation, excellent cash generation as well. And all of that has enabled us to continue to make substantial investments to support our future growth. That's both organically and through acquisitions, and we'll talk in a bit more detail about the 7 acquisitions we've made in the year to date. And that strong performance supports a 7% increase in our interim dividend, which reflects our continued confidence in our future prospects. So with that brief introduction, let me turn it over to Melanie, who'll run through some of the numbers in a little bit more detail. Over to you, Melanie.
Thank you. As you heard from Charles, we delivered strong growth at high returns. So that revenue of over 1 billion for the first time was up 13%. And that adjusted EBIT over 200 million for the first time was up 17%. And that's with the EBIT margin improving 70 basis points to 20.7%. Our return on total invested capital, which is our main returns metric, was up 110 basis points to 14.3%, and that was driven by the strong level of constant currency profit growth. That's actually slightly ahead of our 10-year first half average return on total invested capital, and it remains well above our weighted average cost of capital. In the half year, we've also invested over 130 million to support our future growth. So we did that both organically and inorganically. So our R&D spend was up 8% to 54 million, and that represented 5% of group revenue. So that investment is really critical for our companies to continue growing over the medium term. It's also a really good reflection of the opportunities our companies see for the future. So it's pleasing to see that our companies remained well invested. We also made 4 acquisitions in the first half. 1 standalone, so a new company to join the Halma Group, and 3 bolt-ons for our existing companies, and invested £84 million. You'll also hear from Charles that we've made 2 further bolt-on acquisitions since the end of September, our half year, and we also just announced a standalone acquisition last week. So the total spend year to date is now at £158 million. Looking forward, our M&A pipeline remains healthy across all 3 of our sectors. So it's great to see the acquisitions we've recently made contributing more than 4% to EBIT growth in the half. All of these investments are enabled by our strong cash generation and our healthy balance sheet. So let's take a look at some of the metrics behind these on the third line. Sorry, Alex, still on the same slide. I'm going on for quite a while. Our cash conversion at 108% is strong, and it's well above our target KPI of a 90% cash conversion. And thanks to this high cash generation, our net debt to EBITDA 1.27 times has come down very slightly from the year end. And that's after the continued substantial investment that we have made both organically and inorganically. And finally, our continued growth, our high cash generation and strong balance sheet support an interim dividend increase of 7%, as you heard from Charles, and that puts us on track for our 46th consecutive year of dividend growth of 5% or more. Next slide now please, Alex. Let me take you through the performances that we saw in all three of our sectors. So the safety sector, building off a strong financial year 24, delivered an excellent performance in the half. Revenue was up 11% and profit was up 20%. Really pleasingly, that performance was broad-based with positive revenue growth across all of the regions and subsectors. So if we look at on an organic constant currency basis, that's the pie chart on the right, revenue and safety grew at 10% or 9.6% to be exact. And that reflected double-digit growth in the US and Asia Pacific, with the growth broadly spread across all of our subsectors in safety. It also reflected good growth in the UK and what we call other regions, while Europe's growth was slightly more modest at 4%. Growth in the UK and the other regions in Europe was primarily delivered through a really positive performance in our fire safety subsector. And in Europe, that strong performance was partly offset by slightly weaker trends in what we call worker safety. Profit in the safety sector was up 20% on a reported basis and up 18% on an organic basis. And it was up across all subsectors as well. Our safety margin was also up 190 basis points, and that benefited from stronger sales growth, from a more favourable product mix, but also good discipline on costs. And our profit performance also included a good contribution from recent acquisitions, including LaserSafe, which is a machine safety company that we acquired in Australia just over a year ago, MK Test, which is a high voltage electrical testing business based in Somerset in the UK, and our Australian fire company Ampac made a recent bolt-on of a company called GFE based in Portugal, which is a fire systems company. If we turn next to the environmental and analysis sector, or E&A, if I go for short, apologies, but it's a long name, it saw very strong reported and organic revenue growth, both at 27%. And in addition to that, all of the regions grew revenue. If we take a look at the detail by region on that organic constant currency basis, the main takeaway here in that sector is that there was very strong growth in the US. That was primarily driven by photonics in what we call our optical analysis subsector. And that reflected growth in the demand for technologies that support the transformation of digital and data capabilities. In particular, that was related to the continued successful execution for a long-standing customer. Europe and the UK both grew well, and that was driven by leak detection solutions within water analysis and treatment. And in the UK, it was also driven by a good performance in gas detection within environmental monitoring. Asia Pacific also saw good growth, and that mainly reflected an improved performance in spectroscopy in China. In terms of profitability, profit increased by 36% on an organic constant currency basis, and the profit margin saw some recovery compared to last year, improving 190 basis points to 22.8%. If we now turn to the healthcare sector, still on the same slide, Alex, apologies, but it delivered a slightly more subdued performance, and our reported revenue growth there was 1%, but we did see a decline of 2.5% on an organic constant currency basis. By geography, the US, Asia Pacific, and other regions all grew, but we did see a decline in Europe and in the UK. So taking that organic constant currency basis, there was modest growth in the US, and pleasingly that reflected early signs of recovery in healthcare markets. And in Europe, the revenue declined, and the key driver there was weakness in our eye health therapeutics businesses within the therapeutic solutions subsector. And that compares to a very strong performance that they delivered over the past 2 years in eye health, reflecting some delays to some customer product launches and also a little bit of overstocking by customers. In the UK, revenue was lower, and that reflected some budgetary caution by healthcare providers. Turning to Asia Pacific, revenue there grew modestly, and that principally reflected a gradual return of demand in life sciences in China. In terms of profitability in the environmental and analysis sector, the profit margin decreased 260 basis points to 20.8%, and that was against a strong comparator in the first half of last year. It was good to see that our gross margin was stronger, and that's a good sign of the value and use of our products to our customers. But it was more than offset by the effect of the revenue decline in our higher margin eye health therapeutics business. So to bring some of those numbers to life, because I've stayed on this slide for a very long time, let's take a look at a video which shows the impact our products have on people's lives. And Alex, if you can please play the video, thank you. Great.
Les risques d'incendie sont majeurs sur les chantiers de construction et chaque jour, le danger est réel. Arboretum est un chantier grandiose. Il y a 7 bâtiments, 125 000 m². Toute la structure est en bois et on imagine bien que le bois est très sensible aux incendies. Donc la sécurité incendie est très importante. En plus de l'équipe humaine, la technologie devait nous aider à sécuriser ce chantier. Ramtech est une société innovante avec des produits sans fil de connectivité et qui propose de nombreux services pour les chantiers. Il est important pour Ramtech Orama d'avoir une relation de proximité avec ses partenaires, question d'image, et pour une relation professionnelle, le système nous permet d'évacuer ce danger le plus rapidement possible. Le risque incendie est permanent et nous contribuons à protéger tous ces gens.
In the US, we lose 7 billion gallons of water a day, which is 30% of what's lost worldwide. The reason that it's so hard to find these leaks in the States, the pipe infrastructure is over 120 to 150 years old. We're dealing with northern climate, so the pipes break in the spring. In certain areas of the country, the ground is very porous, so the leak never surfaces.
So the village experiences around 20% non-revenue water loss each year. We would like to cut that non-revenue water loss in half.
What our technology does is help find those leaks. We can monitor the entire system while they sleep, and when they go to work in the morning, we can go in and say, hey, it's this section of pipe, dig here. In Oak Park, we started a trial with 200 loggers. It's a little less than a third of their system.
Historically, the village utilized manual auditory leak detection in order to identify leaks throughout the network. We started to look at options in terms of sensor-based leak detection. The sensors within the network can all communicate together, and utilizing the same data can then correlate where a potential leak is actually occurring. And it's been really successful in helping us pinpoint the exact location of leaks that we may never have been able to identify without it.
That day, I went away almost 40 weeks pregnant.
Xena is one of our fantastic nurses, so we just got to chatting, seeing how she felt.
The job said that you look so weak.
Something was off. Our team felt that if she continued on, the likelihood of having a problem with the baby was high.
You can imagine she was anxious, but we were able to calm her down and we put her on fetal monitoring.
In her case, she was doing fine until there were fetal heart rate changes.
That was when we took her in and did a C-section. We were able to act very rapidly, and this was a result of monitoring her. I do believe that her baby probably would not be here if it wasn't for PeriWatch. They've created a tiny living thing in my life. Somebody who can make me laugh.
Right, you should be back on the next slide now. Is that okay?
That's perfect, Alex. Thank you so much. And I think hopefully everyone managed to catch some of that video and those 3 fantastic examples, one for each of our sectors, but of the impact that we have on people's lives day to day, the positive effects that we can have as a company. And you know, we're really proud of that. Also interesting to note the geographical spread there. One example in Europe, one example in North America, and one example in Africa. So it really is a business, you know, Halma really is a business with global impact and huge impacts on everyone's lives day to day. So let's talk a little bit about the businesses that we've added in the year to date, and how we've grown through acquisition, how we've added new capabilities to grow that positive impact. And you can see that we've had really positive momentum so far this year. As I mentioned, we've made 7 acquisitions so far this year, and we've continued to invest across our sectors right through the varied market conditions that we've seen in the year. As Melanie mentioned, we spent 158 million. Let me highlight 3 of those acquisitions, one in each of the sectors at the top of the page. And each of those are focused on long-term growth trends. And they're really good examples of how we use M&A to enter new and adjacent markets and to expand existing market positions. So let's start with MK Test on the top left there. And that's a company supporting the energy transition, growing our presence in high voltage electrical testing following our recent acquisition of VTech. In the middle, we have Haythorn, expanding our company Minicam's capabilities, helping to ensure clean water and prevent pollution. And then finally, Lamide Nouri to the top right, a recent acquisition just made in the last 10 days or so in minimally invasive surgery, and that's adjacent to our existing presence in diagnostics. So a great acquisition which helps deliver improved outcomes for patients and driving excellence in healthcare. It's also really good to see, as we show at the bottom of the slide, that we're using bolt-on, more of our companies using bolt-on acquisitions to further their long-term growth strategies. So 5 of the 7 acquisitions we've made in the year have been bolt-ons for our existing companies. And then looking forward, we've got a healthy pipeline, and our leadership teams, our company MDs, and our dedicated M&A resources are actively pursuing opportunities in their markets to further grow and diversify their portfolio. So watch this space in terms of further activity. So let's go on to the next slide and look at our performance against our KPIs in the year. And I think this is obviously a key slide for you as investors. How do we benchmark against the targets that we've set for ourselves? And it's really great to see that across the board, this is a really strong set of results. And I think it's especially something we can be proud of given the varied conditions we've seen in a number of our end markets, as Melanie outlined on that slide about our sectors. In short, we've met or exceeded all of our financial KPIs. We've seen strong growth at high margins, a good profit contribution from recent acquisitions, profit growth resulting in strong EPS performance despite adverse currency and tax movements, cash conversion well over 100% and very significantly over our threshold of 90%. Our companies have remained well invested both organically and, as you've heard, inorganically. And our return on total invested capital, or ROTIC as we call it, at 14.3% was significantly up from last year and well ahead of our weighted average cost of capital. So those high returns and that strong growth, coupled with a disciplined risk appetite, means that we continue to create significant value for our shareholders. In terms of our guidance then for the future, on the next slide, the strength of our first half performance means we are well placed to deliver our existing guidance for the full year. While we continue to experience varied conditions in our individual companies' end markets, for the year as a whole, we expect to deliver good organic constant currency revenue growth and an adjusted EBIT margin of around 21% in the middle of our target range. This is additionally supported by our group order intake, which remains ahead of both revenue in the year to date and the comparable period last year. Overall, we're well positioned to make further progress in the remainder of the year. And with that, I'm going to pass you back to Melanie to cover off our performance over the longer term on the last slide.
So these results that we've just reported further extend our track record up here on screen, as you can see, of delivering strong and compounding revenue and profit growth. It's really great to see our 10-year compound annual growth rates of both revenue on the left and profit on the right in excess of our KPI at 12%. And this has been through a volatile period for economic and geopolitical events over the last 10 years. So, for example, the COVID pandemic, supply chain challenges, and also significant government and policy changes. Importantly, if we look over the longer term, our continued performance demonstrates the benefits we derive from what we call our sustainable growth model and the importance of the long-term, really fundamental growth drivers that underpin our growth in our diverse portfolio. All in all, it's a very successful and pleasing first half for Halma. And our performance means that we are well positioned to make further progress this year and to deliver strong and sustainable growth and returns for decades to come. And with that, I think we'll open to questions.
Absolutely.
Back to Alex.
Thank you very much, Charles and Melanie, for that clear presentation. We'll keep this slide up there as we take Q&A because it's a good reminder of the consistent performance of Halma over time. And as we mentioned, if you'd like to ask a question, please type it into the chat box at the bottom of your screen. We've had a couple come in ahead of time. We've got a couple have come in already. So let me start with that first question, which is, how do you think the mix between organic and acquisitive growth will look like going forward?
Shall I take that one, Melanie? Yeah, I think that's probably a good. So actually, it's quite good that we've got this slide up there. So of that 12%, about 7% of that growth has been organic, so a little bit over half. And let's just step back a bit and think about what our targets are for both organic and acquired growth within the business. So our KPIs are for 5% organic growth and 5% acquired growth. And our aspiration is to make each of those numbers 7.5%. So total growth KPI of 10% and an aspiration to reach 15%. As you can see, we're delivering pretty much in the middle of that 10 to 15% range at 12%. Slightly more biased towards the organic. And I think that tells you that, that there's a little bit more opportunity for us to perhaps grow the M&A a little faster over time. But I don't see the mix altering very significantly from the sort of current level. So broadly, we're targeting 50-50. Historically, we've been a little bit more biased towards the organic side of things, which is in many ways great because obviously that organic growth is cheaper, it's more certain, it's lower risk.
Thank you. Another question here on the financials. Are the EBIT margins above 21% sustainable? And how high could EBIT margins go in the future beyond 21%?
Okay, we actually target a range on EBIT margins, and that range is 19 to 23%. Our guidance for this year, as the questioner I think assumes, is that we're guiding right for the middle of that range, around 21%. So a very clear piece of guidance there. We're not aiming to necessarily grow that. It will fluctuate in any particular year, depending on what's happening in some of our markets. But really what we're trying to do is be consistent within that range and then drive strong growth at the top line. So our model is strong top line growth, very healthy margins. I think you'd agree that the 21% this year is a 21% EBIT margin this year is a healthy margin. And then obviously strong and compounding returns at the bottom line. So very much targeting a range rather than continuous growth in the margin.
Okay, thank you. Question relating to the recent budget. Have the changes in the recently announced budget had an impact on how you run your business?
I think that's probably one for Melanie to tackle.
I'm happy to take that one. I think if we're talking about the UK and the UK budget, I think just to put in context, UK is around 14% of our revenue. So we are a very global business. And as well, I think to put broader context around the business and how we're managed for the long term, This year, our half-year results put us on track to deliver our 22nd consecutive year of record profit. So those 22 years are through a wide variety of economic conditions, of different administrations across the world, many different changes, crises, COVID, etc. through those 22 years. So I think, you know, the way we manage the business and with our growth underpinned by really fundamental long-term growth drivers means that these short-term fluctuations from budgets and different governments don't tend to have a particularly noticeable impact on the business. If we're turning more to the budget and thinking around national insurance contributions, for example, which is possibly what the question is getting to, you know, our businesses are very agile and they tend to be able to manage costs very well. And particularly because of the high value in use of our products to our customers. So they're high gross margins and able to manage their costs very well. If we look in terms of the context of the group as a whole, those changes to national insurance contributions, for example, will have less than 1% impact on our profit. So not particularly material at a group level.
Thank you for that. Looking at one of your divisions now. Question here on the healthcare division, and the question is: the healthcare division appears to be struggling both for the last full year and also in the current year. What are the main problems here, and what action is being taken to address this situation?
Yeah, maybe if I take that one, and I think probably the first thing to say in healthcare is we are not alone, and you know, we always say that we are resilient to the influences, the broader influences that we're seeing in the marketplace, but we're certainly not immune. And we've seen that, as the questioner rightly points out, in healthcare. And I think to some extent what we've seen over the past maybe 4 or 5 years is a very significant expansion of healthcare budgets and the stocking levels of product within healthcare systems during the COVID pandemic and immediately after it. And to some extent, we're seeing a bit of a backlash against that now, and those budgets are being managed more tightly by some of the healthcare providers, and some of those stock levels within the system have come down. So we're seeing, you know, budgetary constraints and a destocking cycle within healthcare overall. I think the good news is that we're beginning to see in this set of results is that we are beginning to see some recovery from that, and that's apparent in our performance within healthcare in the US, for example, which is the largest portion of our revenues, and in Asia Pacific. So we're seeing the beginning of some green shoots of recovery, to use a rather hackneyed phrase, coming out of healthcare, which I think is important to see. We're not expecting it to be quick. We're not making heroic assumptions. Behind that, our companies have been very good, very agile at making sure their cost bases are appropriate for this current environment, while continuing to invest for the medium term. So I think the other thing we've done is, even though healthcare market conditions have been quite subdued, because we believe in the long-term growth drivers for healthcare, the fact that populations are getting older, they're needing more healthcare, there's more treatment types available, and people want better healthcare, those drivers are not going away. So we're very confident about the medium-term growth drivers, and the financial strength that we have within the group has enabled us to continue to invest in healthcare businesses, both organically and through acquisitions, right the way through this period of subdued market conditions, which I think is, you know, is one of the great strengths of the group overall. So, you know, the good news, as I say, is we are seeing some green shoots of recovery within healthcare, and that the healthcare sector is well placed, and we are continuing to invest behind its medium-term growth prospects.
Thank you. Now, moving to the largest market in the US, we've had 2 Trump-related questions, so I'm going to ask them at the same time. The first one is: with the US the largest market for Halma, will the rumored Trump tariffs have an impact on Halma? And the second question is: do you think a Trump presidency will have a positive or negative impact on the business looking forward?
Do you want to do the tariffs and I'll do the presidency?
Yeah, sure. Although almost, it's almost worth putting the context around the presidency first, isn't it? Do you want to take that one first? And then I'll get more specifics.
Yeah, I mean, look, I think, again, I think it's worth looking at the slide that we have on the screen and thinking of all the things that have happened in that 10-year period. And by the way, it wouldn't be a wildly different slide if we extended it back 20 years. I think we've managed to deliver very good performance, and as Melanie says, you know, we're on track to deliver our 22nd consecutive year of record profits, despite all the changes that have happened in the world, whether that's, you know, Brexit or COVID or whatever it may be. There's been an awful lot, you know, the global financial crisis, for example, there's been an awful lot going on in that period of time, and yet we have continued to deliver. So I do think, you know, we have a very resilient model. We have a model that serves some very fundamental needs, and you know, so to some extent we're pretty agnostic around the administrations we see. Obviously, you know, we're keen that the governments continue to invest behind or encourage investment behind the areas that we focus on, so safety, healthcare, and the environment. But those needs don't go away. Those needs continue to grow, and we continue to grow our capabilities to provide those solutions to our customers overall. You want to have a go at the tariffs?
Yeah, I'll cover the tariffs. I think that was really good context as well around the tariffs and our business really being, the growth in our business really being driven by those long-term fundamental issues that we're solving for our customers. So I think relative to the more globally integrated models of some companies you might look at, our business model is much more local to local. So, you know, think of local boards of directors in a particular niche serving their customers locally. So we put our companies close to their customers. Broadly speaking, around 70% of our company revenues are in the destination in which that company is based. So very much selling predominantly local to local. If you look in the US, that's actually around 90%. So our companies are selling 90% from the US into the US. And so that is very much our customers focused on serving their local markets. And probably also, if you look at the supply chain, probably also sourcing components more locally than other companies with globally integrated supply chains, for example. Our companies also operate in those niche markets. As I said, they're underpinned by those long-term fundamental growth drivers. And that helps give us a really high degree of price resilience because of the value we're creating for our customers. Also within the business model, having our full boards of directors in these niches of our companies just living and breathing whatever solution they're delivering, it gives our companies much more agility within our decentralized autonomous model. And that means that our companies are really well placed to make the appropriate decisions for their businesses, for their customers, and for their supply chains. And our companies have been proved really agile through time, during COVID, for example, during Brexit, during the supply chain challenges that we saw as well. And then I think the other point is we have some learnings from the more recent US-China tariffs that were in 2016, is that right?
That's right.
Around 2016. So we have some really good learnings from having gone through that. In particular, where we were just changing the category of how you categorize a product might make a difference. So we're sharing those broadly across the group. And as Charles said, you know, coming back to our track record, being on track for our 22nd year of consecutive record profit, we think that places us well, coming through all of these different cycles. So in all, we don't think this will have much of an impact on the business.
Thank you for reassuring us there on both those points. We've got a couple more questions, but again, just a quick reminder, if you do want to ask a question, please type it into the Q&A box. Next question up, I hope you've got your financials hat on, both of you. Can you comment on the tax receivable on the balance sheet after the EC result and the pension surplus remaining after the recent buy-in?
Yeah, okay. Let me do the tax receivable. Melanie can cover off the pension surplus. So the tax receivable, we've already, So basically, we were required to pay a tax bill in relation to an EU court decision some years back. We've always expected that decision to be reversed on appeal, and it recently has been. So we think there is now a very high probability that that money will come back to us. So it's for clarity, it's 13.9 million plus interest. Over time, that will come back to us. We are not quite sure of the timing as to when that's going to be delivered, but it remains a receivable on the balance sheet.
And just coming to the pensions, and what did we do the buy-in as the very well-informed questioner puts it. So what it means is that we've actually purchased an insurance contract to match the liabilities for our 2 UK defined benefit schemes. These were already close to new contributions since 2014. This contract essentially removes a number of the risks on investment returns, on longevity and inflation, for example. It didn't have an impact on our cash flow. And as we've already set out, we're not making any contributions to these schemes. They were already in surplus. From an accounting perspective, matching the liabilities removes the accounting surplus that we previously recognised on the schemes. Well, almost all of it, as you said. So the surplus has moved from 30.9 million at the end of the year to 3.6 million now. So essentially the insurance contract was funded through the surplus. And so that strong funding position of the schemes and combined with the favourable market background meant that this was a really good time to execute this buy-in.
Yeah, probably just to add, that remaining surplus relates to a couple of small overseas schemes.
Thank you. Last question here. What sector or end markets do you think has the most attractive growth characteristics for Halma going forward?
Well, we're really excited right across our sectors. So, we are deliberately investing across our 50+ companies in markets, as we keep saying, with very strong, very fundamental, very long-term growth drivers. And we're seeing great opportunities. And I think one way that you as investors can track that is the level of investment that we're putting into that each of our individual companies are putting into those markets. And a good proxy for that is the research and development expenditure, which, as Melanie said, grew 8% in the first half of the year. That's a really good proxy for the opportunities our companies are seeing and the scale of the options open to them to grow over the medium term. So they're putting that money in the expectation of getting good growth and returns for the future.
Great, thank you. Well, as I said, that brings us to the end of the Q&A section and the end of today's webinar. Thank you very much to Charles and Melanie for presenting so clearly and answering all those questions. Thank you to everyone for attending today. I'd just like to remind you that as you leave today, there will be a feedback form. It'd be really appreciated if you could just spend a couple of moments completing that. I know management really do appreciate your feedback on these events. So look, thank you to everyone for attending, and we look forward to seeing you all soon.
Thank you very much, everyone. Very good that you could join. So we'll come back and do this again soon. Thanks very much.
Thank you.
Thank you now. Bye-bye.